Hola, se me oye bien.
Hi, good afternoon, everyone. I would like to thank BME for allowing me to moderate this roundtable with this distinguished panel, where we will try to answer the question whether it is the right time to invest in small and mid caps. We have distinguished panelists. We are going to start with Itziar Puel, Director of Equity Spain at CaixaBank, Ricardo Seixas, Director of Equity at Bestinver, Javier Galán, Director of Equity at Renta 4 AM, and José Ángel Fuentes, Director of Equity. So we want to provide an overview of mid caps and of equity investments, and please feel free to answer your questions, to contribute your own ideas. I hope you have lots of ideas, and without further ado, I think we can start, because the universe of small and mid caps is a very specific universe of investment that offers lots of opportunities, and the doubt is whether with this shift in the context, mainly in the last year, towards policies where high interest rates are becoming more prevalent, whether it can be a better scenario for investment. So we are going to start with you with a very specific question, but a very open one: pros and cons of investing in mid caps in equity. I would like to thank BME for the invitation to take part in this panel. Pros and cons. Cons are always related to liquidity, but pros are becoming more important than cons. I'm very passionate about the small cap universe. Those are the companies that offer great opportunities to invest right now. It is true that in an environment of hiking interest rates, they have more problems to finance themselves, and they pay higher rates, but I think that they have valuation that is lower. The ratio is quite interesting, and if we look at rates, at interest rates, they have sometimes a better liquidity position compared to the big companies, and that is very important. Within the small and mid cap universe in Spain, we have 21% of companies that have cash in their balance sheet, while large company, only 7% of those have liquidity, have cash. And if we look at other ratios like the free cash flow, which is one that we look at very often, and they are also very cheap and they provide very good returns. I don't want to get into figures. I don't know if my colleagues want to get the discussion down to figures. But then the problem sometimes for an institutional investment is the lack of liquidity and the lack of knowledge, because very few brokers cover those companies, and it is the manager's role to get to know the companies, to put a face on those companies, and to search for the best opportunities. I don't know if I have gotten carried away, but that's my opinion. I don't know if any other panelists would like to say something else, perhaps something that she has not mentioned yet. No, I think she has reviewed all the pros and cons. I think that the small companies have a lot of variety, but in Spain, we, except for the 35 in the IBEX 35, the rest are small and mid caps. So we have a huge universe. And in terms of valuation, very scarcely, very rarely in history, we see indexes of small and mid caps lower than the large cap, the big cap companies. Stock, the IBEX small with the IBEX 35. If you compare, you don't normally get this situation that we have right now. So it is a great opportunity. Sometimes if you pay the cheapest price, you may have problems and end up paying more, but there may be opportunities. Yes, and if we see lower valuations compared to the large caps, could that have an influence, or can there be a bias towards small and mid caps? Because everyone is, the context has changed so much, and people go from growth to value. I don't know if in the small and mid cap universe, whether there is a bias in those companies, or do we have to look at those companies one by one? No, of course you have to look at them one by one, but of course common sense tells you that small companies are in a less mature point in the business cycle, so they have potential for growth, and that is what, in my opinion, explains that in the last 15 months the small companies have done worse, with drops of 20-25% in the last 15 to 20 months, and the largest capitalization indexes are almost flat, and that's what explains that they are now cheaper, those small caps. But growth and value are a narrative or a discussion that we have to get rid of. I think that we have to forget about that. We advocate investing in good companies, in quality companies, and in order to have quality you need discipline. What is a quality company? It has to fulfill certain criteria, that have companies that have a predictable growth and visible growth in the next few years. Of course, Viscofan, for example, they are leaders, undisputed leader in meat, and they are growing 4 to 5%, and they also capture market share because of their positioning, and they are more efficient, and in 3 to 5 years demography emerging, and I could expect that they will make more money. That is the questions that we have to ask ourselves. Companies that are growing and that it is reasonable to see them grow with low leverage and large margins. With that premise, you can prevent the disappointments that come up when corrections take place. If you are nervous about the company going bankrupt, if they have large margins and they have liquidity, they don't have too much leverage, you get rid of the emotional fears. And then, of course, you have to look at more technical stuff like the return on capital employed, management quality, and small caps. That is fundamental, and they are very accessible. You can speak to the managing director of Michelin. That is going to be more difficult than going to Atrix or Viscofarm, that are smaller companies and that are more approachable. So that is my recommendation, really. Okay, we've spoken about this change of context, but I don't know to what extent the development of economy has an impact on the stock prices of the small and mid caps, whether that influence can be bigger or smaller than the large caps. What correlation is there between the development of economy and the stock price of those companies? Well, I believe that macroeconomy, of course, has an impact not only on the large companies but also on the small and medium-sized ones. More than 50% of the GDP, world GDP, is represented by small and medium-sized enterprises, and that's what really feeds the world on a daily basis, or at least the majority of the citizens in the world. But of course, they are also subject to local economic factors and also to the global ones. What does change, in my opinion, but it is quite apparent for the small and mid-cap world in Spain, is the depreciation vis-a-vis the Spanish economy. Of course, it is easier when the Spanish economy is above the average of the comparable benchmark countries, as happened in the last period, in the period 2001 to 2008. Spain was growing more than the rest of the Western economies, and those types of companies will normally have a premium. When an investor wanted to come to Spain to search for investment opportunities in the small and mid caps, they would have to pay a premium. And then another important element that is quite reasonable is that many of those companies, or the mid-sized companies, are also international companies, and they depend very little on the Spanish economy. That's a difference between the small and the mid caps, and that in the mid to long term will differentiate you. But when the risk premium in Spain hikes for whatever specific reason, those companies, the small caps, will suffer more, and the correlation is normally quite straightforward. Okay, and in the case that is for institutional investment, and what happens with retail? Do you see that correlation as well? I think the appetite for investment is always subject to how macroeconomy flows. We've gone in the last 3 years. We've gone through ups and downs in the GDP, both of the world and also nationally, domestically. We have recovered in the last 2 or 3 years close to 9%, but of course the influence is just the opposite. When things are not working well, retail was not purchased, and institutionals were the good ones, and now things are upside down. Retail becomes perhaps more attractive now. Okay, and those retail investors, well, apart from the context itself, there's also the impact of the media. And when you speak about equity or fixed income at global level, you see shifts in flow. For example, in Inverco, you see that in domestic equity, when there are flows, they are quite small. So, Ricardo, I don't know. Why do you think that flows influence? To what extent and how are they having an impact? When you invest in Spanish stock markets and you invest in small companies, why can you, what business case can you present to make them attractive? I would say that there are different aspects. One is coverage, as was said before. The hedging, the fact that you start from an institutional perspective investor point of view. If you have more global approach to investment, you drift away from the small caps, because if you go to a bigger region, you cannot cover both big and small companies, and you have to stick to the big ones. The passive funds are typically passive towards large cap indexes, so there is no replica there. And then in the post-MiFID, the brokers themselves are also becoming, to some extent, the global ones are the winners. And that has to do with the fact that the large capitalizations are the ones that bring business, so they cover less the small ones. So it is a double effect of drifting away from the small ones, and that generate a bigger opportunity in that universe. So if we add together the typical periphery that was so controversial with the financial crisis, but if we add to the fact that we are a peripheral market, that we are a small market, by definition, the whole market is a small one. And so we are perhaps out of the radar of many of the investors, both retail and institutional, and that is exactly what generates that opportunity. So from the point of view of an asset allocation of an institutional, they should be looking at perhaps an add-on or an overlay of specific topics to provide you with that potential to overcome to beat the average. And then in terms of the retail investors, I think that the trend that exists right now at a domestic level, people believe that they have Iberdrola or Telefónica that they inherited, and that's all that there is in Spain. So we have to understand that this market is not always about Telefónica and Iberdrola. That's why we are here for. We are here to choose the things that have greatest potential for growth and that can provide you with a better return. I would like to make a remark. I think that in a global portfolio, you have to have some diversification of assets, and the small and mid caps are like the salt and pepper. You don't need to have 50% of your portfolio, but if a customer with a conservative customer, you can have a small bit, because they behave differently from the market compared to the larger companies that have much more hedging, have a very well-known drivers, and the small caps. I see many small caps that are here in this conference room. They are so diversified at sectoral level that they give us something to the managers that we cannot achieve with only the large caps. So our task and our added value in a global portfolio is precisely to do that, to keep an eye on those. And with the current evaluations, I think that we are in the best possible moment to go into this investment universe. Yeah, we are seeing that in companies. Many of my colleagues will also have positions in A+, a Spanish company that whenever I look at it, I see it extremely cheap. And in the end, if it is not the market that sets the price, it will be the private equity or some competitors or someone. But the valuation will come at some point. The company has to be a good one, and the price and the valuation will come at some point. So the non-coverage of some companies, or a very weak coverage of some companies, generates lots of opportunities for us, because there is no liquidity, there is no interest to buy, and when there is, the increases can be 50% in a couple of days. Yes, that's what happened with A+. It was listed at half their European competitors, and now everyone wants to buy A+. Yes, but these types of operations are corporate, some private equity that purchases your company. You will have some of those in your portfolios and you will be happy, but don't you fear that the market can become dry of that type of company, because there are so few companies going public and your universe might decrease too much? Or do you think that you have a universe that is big enough to be able to select? I think that there's even higher correlation with the economy. When we go into an expansion movement, those exits will happen, and they will probably happen in companies that are looking for financing. They are at that stage, in a previous stage or a more early stage in their life cycle. But I believe in the market economy, and the market is a source of funding. Regardless of the valuation, someone can take it away from you because the valuation is very low, but there will be others. Yes, but if they are venture capital, they will come back, don't worry. We've seen many cases where they come and go, companies come and go, and there's been a stop for 1 year, but I'm sure that there are many companies waiting to go public. You've spoken about the ratios that you are using. I will start with Itziar, but I will like all of you to answer, because you will all have your investment process and it will be very interesting. What are the indispensable ratios that you have to see in a small or mid cap to include them in your portfolio? Well, I do look at the ratios, but above all, I look at the type of company. I look at the business plan of the company, and I need to believe that whether if they are in the sector that correlates to that business plan, they have to have a solid balance sheet. If they are going to increase capital and to expand, that's excellent. But I want to know what they do and what they have been doing. And I need to get to know the management team. I need to put a face on those figures. I'm going to lend my money, or the money of my investors, and I will pursue them forever if they deceive me. So I also need to see the momentum of the sector, whether there are M&As and so on. And then ratios, net debt EBITDA, that ratio is very important. They can have a lot of leverage, but it has to be reasonable. The large caps are 2 times EBITDA in leverage, and the small and mid, they are below half that ratio. But of course, we look at that but it is not the only thing. And also the enterprise value, EBITDA, free cash flow. So the large caps have a free cash flow of 1.1, and the small and mid caps have almost 5 times. So I will look at those things, but for me, business is much more important, because as Javier said, those are companies that are growing, that are starting. I cannot say one pair below 10. Because that is the consequence of a good piece of work through a business plan where we want to accompany them. We want to be there with them. We believe in their project, and that's what I look at, and I'm not going to give you any more data. Just to add something, of course, the basis, we all agree on that, but we don't want to see a snapshot at a certain point in time. We need to provide context to that, and that's why we try to look at the whole movie, so to speak. We want to know where they come from and where they are heading towards, not only what they tell us that they are going to do, but also what seems natural because of what we know of the sector, about the comparables, whether that is compatible, and we put together our own picture and our own movie about that company. And that's when we decide that if they are here and they are heading towards this place, we like this company. Yeah, I fully agree with my colleagues, but I also like to look at the conversion of accounting into free cash flow. That conversion of operational margin in free cash flow, if you manage well that life cycle of stock, if you the collection and the payment cycle with customers and suppliers, if you have done that in the past, that comes to show that you have a good management, and the margin in the end, whether it becomes cash at some point. If it becomes cash, you will see quite a healthy balance sheet. You will see that growth has been quite orderly, and that's a variable that I look at very much. I like to keep an eye on that. It is impossible in a large cap. In a mid or a small cap, it is much easier to do. And more so if you do what Ithia said about engaging with the management team. You should know that we travel to companies, we travel to the field. We don't just go to very neat offices to see management teams. We also visit the companies on the ground, and we like to see that. Yes, of course, we all do that, and the asset managers in Spain, even though we compete to get more profitability, but we all get along quite well, and we see each other, and we meet in common meetings with executives at factories and so on. I would like to delve a little bit deeper into ratios. I think that there's a mistake, a very widespread mistake among retail customers that look only at the PER or the EBITDA for today, but only for today. But today is the past. That is more than contemplated in the market. So what we have to decide is this company, based on their historical track record, what is the most probable EBITDA and profits that they will have in 3 to 5 years. And that is a key for success, not just looking at the static piece of data, but also look at the development and at the projections. If you see the profits today, they may be cheap, but perhaps 3 years down the line, they are not. And I'm not criticizing anyone, but for example, in the telco sector in Europe, there are companies that they are always very cheap. Apparently, they are always very cheap. But if you look at the historical track record or chart of the profit, you see that the profit 10 years ago was 10 times PER, very cheap in Deutsche Telekom, Telefonica, Orange, or something like that. but it decreased 70%. So you were purchasing not the pair, 10 times the pair, but 50 times the pair of 2020. What is important is the profit that will be generated in 2 to 3 to 10 years, for example. So you haven't mentioned, and that is striking for me, ESG. You have spoken about ratios, about financial ratios. We should also look at the extra financial analysis that is very trendy right now. You have spoken about the G, the governance, but are you applying that filter of the ESG considerations when you select your portfolios? What do you do about that? In our case, we start with an internal process. It was easier for us to analyze the G, of course, because we have been speaking to the companies and to the executive teams for a long time, and we knew what their processes were. But we also had to make some research for the E and the S, for the environmental and social. And there, I think that we identified that we needed more capacities and with more capabilities, because we are normally very focused on understanding the business plan and deciding whether the company or the sector is worthwhile devoting part of our portfolio to invest in them. And what we have done is to specialize that part of the work and to hire people to really decide according to a set of ratings whether our portfolios are ready to comply or to fulfill a sufficient ratio from an ESG perspective. So we look at the law. We have Article 8 funds. Majority of our funds are Article 8, and there are 2 that are Article 9, and that are focused on the more social part, which is a fund for social impact, and another one which is focused on the environmental, which is the Energy Transition Fund. But we have a specialized team for that update the portfolio, and they set limits when it comes to investing or not in some areas, in some companies, if they fulfill or not the ESG model that we strive for. If you allow me, in our case, it is slightly different in the sense that it does not influence when it comes to choosing a company or another, because we have a few companies that are directly or forbidden from the point of view of ESG, but we want to be quite active and activists in our interactions with the management of the company. We always try to make sure that the normal weaknesses that we see in that type of company, that they are raised so that they can we can contribute with a little bit to the improvement of those areas. So we make recommendations both at social and environmental level, and of course, as always, in terms of governance, something that we have always done. But the new element in the last, I would say, 3 years, when we implemented that in the whole team, we have the whole team interacting with the management of the companies, has to raise mandatorily some of the weaknesses that have been identified in their ESG policies in order to try to contribute to their improvement or remediation. Yes, and for us it is also very important. We have Article 8 and Article 9 funds, but what we have started to do in a very regulated fashion and with a special department is engagement, which is an active dialogue regarding ESG for specific topics, not only with the Spanish companies, but also European ones. So we meet with the Spanish and European companies so that we can review certain milestones where the red flag is, where there is room for improvement, to keep an eye on them and to make sure that they improve with some deadlines, and we do pool engagement also together with some international investors in order to meet with those companies. And we also do something that is very interesting and that we didn't do before. I've been doing this for many years, and we didn't do proxy voting. We vote in virtually all the companies where we have invested money of the Caixa Asset Management manager. The proxy voting is just voting in the shareholders meetings, and that is something that we have taken very seriously and that really impacts the pocket of many executives. And when it comes to appointing board members and the role of the minority investor, that's what we represent. That is one of the pillars, not just the executive team, but also we deal with the ownership rights as shareholders. So we have a lot more weight in the board of directors and also in the shareholders meetings. And in Spain, in small caps, we always have on the agenda one of those questions regarding ESG. But of course, for many of those small companies, it is a challenge to abide by the standards that are so demanding in the investor world. That is a challenge, and we recognize that effort that the good companies make.
Igual, no sé,
Well, we do exactly the same, and now we have to provide justifications and documentations. We have human resources, and the departments that deal with that are always back and forth with that documentation. But of course, it is important that investment funds manage billions of euros of Spanish citizens and foreign citizens, and we all, of course, have to be aligned with a set of principles. You've spoken about the way in which you select those companies. I know that you all do, company by company, but I guess that perhaps in this context there will be some favorite or preferred sectors, some sectors that you have overweighted in your portfolio, perhaps not just because the company, you like the company, but because you like the sector as a whole. Can you tell us what sectors are you taking positions in? Yes, of course. To get to the current positioning, I would also like to make an overview, to provide an overview of what we have done in the last 2 years. We have gone through several sectors, and that has led us to the position we are in right now. I'm going to start not in 2009 when we started to manage the fund, but during the pandemic. During the pandemic, a very important opportunity emerged, and it was those companies that have been penalized by this anormality, and that's why we invested in those types of companies that were going to recover normality, for example, consumption, hotels, travel, those companies that were going to recover well from the pandemic. Then we go to industrials, and of course we are not always right, but that's more or less the trajectory that we have gone through. And recently we, since the mid-year 2022, with banks are also an important part of our portfolio. Currently, looking at this discussion, we are not very much concentrated in large cap. We have more than 60% of our portfolio in small and mid caps. IBEX has 25% in large caps, just to give you an idea. And we are taking positions right now, perhaps too early, but I think that is going to pay off, is in companies that have suffered due to the hikes in interest rates. For us, the real estate assessment perspective is quite promising. We are purchasing companies that have very good quality assets, like Colonial. More than 60% of their assets are in a very specific place in Paris, where there is almost no vacant flats, and rents continue to go up, and that company is valued at a discount of more than 30% during the previous financial crisis, the big one. The big to trough was 15-20%, so they are their price is even below that metric. And we are also purchasing companies that not only have been damaged by these interest rate hikes, but also because of doubts regarding the thematic. For example, those companies that have to do with the energy transition are one of our poles of attraction. For example, renewable energy companies at this price for us are a good investment, and we have several in perspective. And then companies that are detached from the economic cycle, companies that have a very solid balance sheet, and Logista, for example, where we have an important weight right now. Celnex, which was also influenced by the increases in interest rates, and there was some controversy with the management team. And then industrial companies that were lagging behind because the cycle took them by surprise, and mainly the cycle, the supply chain cycle that really broke down and that took them out of service, like for example CAF, that stopped the deliveries because they didn't find any chips for their vehicles. But of course nowadays we are focusing again on those types of companies. Yes, the truth is that we move the portfolio around too little, not very much. Why? Because in our investment philosophy, which is not value investment, there are things that we don't agree with. Value investment or value investing forces you to purchase something that you think is cheap. You may be right, and then you have to sell because you were right, or you fail and you have to sell because you have failed. So you have to look for a new idea. And so the conclusion is, what happens if we look for companies where we can be shareholders for a long time, high quality companies with a high future profits, and we sit together with the management team and we accompany them throughout their success story. That's what we try to do, and that's how we reduce rotation or turnover, and hence the possibility to make a mistake. If you have a good company, you don't need to be purchasing and selling all the time. You just purchase. That goes against liquidity, that is true, but for the participant in the fund, it is a better approach. In Spain, I would say that, and I'm speaking globally right now, but I'm also a manager for Europe and the US. But we have in Spain very strange companies. We have spectacular ones in the consumption, in the industrial sector, in infrastructure sector, probably the best companies in the world, Ferrovial, Celnex that you mentioned before, Sacyr, which is still unknown, but they have lots of concessions of very high quality, and I think that the investors are not covering those companies. They are a construction company, but they are not only a construction company. And the REITs, the rates, seem to be quite cheap and colonial. I don't think there is a real estate company as with the quality of assets that Colonial has. It is spectacular, and the types of customers that they have. And then, however, other industries where we don't know whether there is going to be a recession in 6 months, whether the expansion is going to continue. We have no idea. But we need companies that are able to manage and to cope with difficult times and that benefit from the expansion periods. And we try to avoid companies where perhaps in 3 or 4 or 5 years' time, how much is IAG going to make? I don't know. Or the Santander, how much are they going to make? Much more than right now, Telefónica. However, there are other companies that have high probability of improving. Vidrala should make more money in 3 or 5 years. Our A Plus should also make a lot more. Viscofan, Amadeus, they all should make more time. We want to focus on those companies where we know that time is on our side, not just looking for the right moment in time to be recognized by the market. The market will recognize that because time is on my side, and because those companies are going to make more and more money every year. And that's our approach. And you find that in technology, health, consumption, and also industrials. That long-time vision, which is a vision that normally investment funds have on a wide scale, but perhaps in small and mid caps, you may invest today expecting to have a return very soon. Does that influence the level of rotation? Do you rotate the portfolio a lot, or is it stable in time? When do you sell? What should happen for you to have to sell an asset or a security? Well, in our case, the turnover of the small cap component is lower than the rest. Why? Because theoretically we are taking them starting at an early age, and we need to give them time for the materialization of that potential. And of course they are also less liquid, and we manage, fortunately we manage lots of money. So we need to we cannot be trading around a small cap, because that is not going to have an impact. We will providing liquidity to the people at BME a lot, but very little else. So in the small cap part, the turnover is quite low. And apart from that, those Iberian portfolios, and just forgetting about the small caps, specifically Iberian portfolios, I think that they demand a more reactive model or proactive model if you can. And that can mean being a little bit more active in the market. So there's a piece of news that has an impact, good or bad, and since our universe is not 50,000 companies, we have to do our best, and we need to manage that pressure. That will entail becoming more active, just the opposite. Regarding triggers to sell, I would say that our philosophy is to sell when the business model goes askew. The investment model or the business model that said that free cash flows were going to continue growing until whatever, then we might become potential sellers of that company. So if they do not fulfill. Okay, sectors. What sectors? Yeah. Well, I love sectors that are in the long run. I love health and telemedicine. I think that is something that is here to stay. Technology mixed together with medicine is, in my opinion, the future, because we are all going to age. Perhaps you don't see it very obviously, but it is true. And after what happened with Ukraine, and now we realize that we need a shift, and everything fits in, and the world of renewables is also here to stay, and we need to get the most of those sectors. And there are lots of companies, and I think that Spain has become a benchmark, a reference mainly for PV, for solar thermal, wind energy. There's a lot of capacity in Spain, but another thing is the valuations that you may have. But if you speak about sectors, I love those sectors: renewables, health, and so on. And I fully agree with my colleagues when they said that many sectors have been penalized by the hikes in interest rates, and now they present an opportunity to grow. Spain has the best infrastructures in the world. Some have gone over beyond the Atlantic, but they continue to be a first level company, and we need to continue promoting that. And as you said, some smaller ones, some less well-known ones, but perhaps there is a lack of knowledge on the part of some investors that say, for example, no, in the past that someone was manager of that company and they have a huge debt. And you can say, no, this commitment to reduce the debt to zero is from last year. So we don't need to stick to the past. We need to keep an eye on the market, and those are the sectors that are interesting for me. I haven't mentioned banks, but the truth is that my colleague was right. They have shifted dramatically, and they are now collecting money and distributing profits, and we cannot get out of there. But in the long run, I see many other sectors better. But for example, what do I do in order to sell a company if they depart from their business model and they tell you that they are complying or are going to comply but they don't, or perhaps the CEO leaves and so on and you don't know who is coming? Those are sometimes reasons for us to get out of positions, because we do not know what is going to happen. That film, that movie that I mentioned before, I need to visualize that. I need to see it, and I need to know the characters, and if they are not the characters, it's not the same film for me. So I need the same characters. I don't know, bearing in mind that you work in the most attractive sectors, but can you think in your portfolios, what you have in your portfolio, what is the greatest risk that a portfolio like yours is facing? I don't know if it's a macro or a micro risk or an unexpected risk, another pandemic or a black swan. Pandemic, I don't even think about another pandemic. I don't want to think about that. But a slowdown of economy, a bigger slowdown. They were saying that the wolves were coming. But now we are all back to consumption again. But a slowdown of consumption, a real slowdown of consumption, could have an impact, because savings in Europe and in the US are coming to an end. The mortgage, the electricity bill, everything is going up, and you can keep that if you keep employment. So a mixture of stagflation with a slow growth and unemployment, for me, that is the most fearful storm, because it all affects the business results of our companies, and that is the valuations and the stock prices and everything. It can change the whole movie in just a while. Well, I would say that anything that generates a disorderly market. A disorderly market is a market that does not discriminate, and that is the worst thing that can happen to the asset managers. If they do not discriminate, we have a problem, and that can come from the consensus of the environment. That is exactly what Lucia was saying, like, for example, a slowdown of economy. That is the main scenario that we contemplate. But if that changes dramatically and we realize that in the end the central banks have gone over the top and we have a recession ahead of us, then of course that can create some disorderly market that really forces us to act. But I didn't want to be too specific, because I think that anything that changes nowadays with a lot of uncertainties that we have right now, if our perception changes about risk and we generate a disorderly market, that is the worst thing for us. I normally sleep well with our portfolio. I'm not concerned about a recession. Recessions last 2, 3, 5, or 7 months, and expansion periods last 10 years. And we have no problem there. We have an asset portfolio, a portfolio of companies with very healthy balance sheets, and ArcelorMittal, they have a huge cycle, but they are always in debt. They will manage that much better than others, because they are always in debt. But I sleep quite well with the portfolio that I have, and the recession periods are normally great opportunities for us and for our customers that have liquidity in the current account, or that have very conservative funds, or they have the bonds and obligations, and there are many people that have a mortgage and they can move that money to creating opportunities, like the management funds that we manage here that are very much advised and in my case, I am not concerned really about it. Oh, you're lucky.
No, yo coincido mucho con
Well, I agree with my colleagues, and just to add something more of a particular note, not someone that has to do with the global economic context, because it is very difficult to predict what is going to happen, and I agree that with Ithia that consumption might not be the engine that we have had up to now, and the potential growth of the economy might be slightly lower. But I think that we are all performing that analysis, and we have that ingredient when it comes to selecting. But what is a concern for me, but that is a qualitative function, is not to have sufficient patience to be able to capture the whole return that we expect we are going to have in the next few months and years with the portfolio that we have right now. I don't know if you have a crystal ball with you. What profitability can we expect now? Well, we have an annualized profitability which is quite decent. Our goal is to keep it. Since we went public, it is between 8 and 9%, depending on the moment. And in order to invest in an equity fund, you need to make that minimum 5 to 8%. And I think that currently there are assets in our portfolio that we are going to double, and sometimes we are going to win 30%, for example. So the exercise that we are making among all the managers that manage either mutual portfolios, we have to be patient. We have to be patient because we are facing a moment of inflation that does not want to go, lack of liquidity, and so on and so forth. So we have a portfolio that is exposed to those factors, and that is, of course, compensated. But we shouldn't let the trees prevent us from seeing the forest. We just need to be patient, and we will end up capturing quite a good profitability. Any crystal balls over there? An estimate. What can an investor that decides to invest, how much are they going to get? No, you want to say something? No, I was going to say that should not be expected from a lady, but we are all quite old, and we all tend towards the same types of errors. If we've been 30 or 20 something years managing the market, in the end you expect that in the long run that trajectory will keep, and that your performance of 30 years in a yearly average can be kept. So I think that environment is quite reasonable for our companies, and it is just looking with a rear view mirror. Yes. I've looked at this because it was striking for me how bad the IBEX has behaved. But they say small caps are taken into account since 2019. They have 6% annualized, and we can all beat it. I guess most of us beat it, which is more than double the profitability obtained by IBEX 35 at that point in time, which had annualized 3.5%, so 130%. So small caps have grown in the last 25 years. They have grown 315%, and IBEX 30% only. So what is normal is that in the next 25 years, at least, we get to a profitability similar to the one that we have had in the past few years. Names will change, companies will change, because we will not have the same companies that we used to have. But in the end, the stocks do not move for the sake of moving, because there's someone behind with a crystal ball. No, markets grow because there is higher productivity, there is growth, demographic growth, and there is inflation growth, because inflation is a piece of data that normally favors the companies because they make more money, and if they make more money, they are not worth more. So in 25 years' time, I think that the same that is happening, that has happened to us, will happen in 2025. Yes, I want to join my colleagues in that 6%. I agree, in that 6%, we've all beaten that. I was not born at that point, but the truth is that the gap that there's there always is between small caps or mid caps or large caps or the IBEX is very clear. It has been studied, and we normally beat the small caps, beat the large caps. But for now, for some time, we've been in an anomaly. But this should call our attention. Why? Why is that happening? Because in the end, everything cascades down to the average. So it is a great opportunity. As I said at the beginning, it is a great time to invest in small and mid caps. I've run out of questions. I don't know. We are now going to open a Q&A session with the people that are attending in the room. I think that we have a microphone, but I don't see stewards. But we can perhaps speak aloud, and that's it. But I ask you to raise your hand and to say your name and who are you addressing your question to, in case you have one. Don't be shy.
El señor de detrás.
The man at the back? Yes, Guillermo Serrano from Checkpoint Partners. Perhaps this is a question for the whole table. Do you have any specific sectors in the mid-term where you would put special attention in your portfolios for that sector? Well, shall I start? Itziar has already said something about this, but I think that there are quite apparent trends for the next few years. Health, technology, consumption, and industrials. For me, those four types of companies, those four sectors are the clearest for me for the future. And then each sector will have its own companies, and every company will have its own stories. But if I had to focus, I would do it in that order. Health, medical technology, that the growth is going to be huge in those two. Technology also, digitalization of the economy, the socialization of companies. We have artificial intelligence now that is an appendix compared to what we have seen in the last 20 years, no? In terms of the development of technology. Consumption, because it is very simple, and companies that produce consumer goods normal or have normally a lot of stability. They keep selling the same in moments of pandemic or moments of difficulties. But then I think that it is huge, the amount of money that has been invested in energy transition, and I guess that there are lots of industries that are going to benefit from that, and that will give them for decades. So let's focus on those companies because time is on our side, and they will continue to grow. Okay, I don't have anything smart to say, but just to say something that is more or less along the same lines, is that, as Javier was saying, all those sectors that are very much related to demography make a lot of sense. And perhaps in terms of energy transition, we shouldn't forget that one of the sectors that has been affected the most by the growth of ESG topics, negatively I mean, is that of oil. Now it has become part of the solution, not just so part of the problem, and that is also an important one to keep an eye on. I agree, I do agree. I think that's exactly what you have summarized, is exactly that.
Sí, usted.
There's another question. Thank you very much to all the speakers for your presentations. Gabriel Nieta from Peira FTS. I wanted to ask a question regarding illiquidity, general illiquidity that normally happens with small caps. Not how do you coexist with that? How do you relate to that? There's a profit warning issued, and do you sell your position or what? Do you ask for a risk price? But small or the small caps, I don't think that there's a possibility there. So how do you coexist with that, and with lack of liquidity? How do you manage that? Well, in my case, I try to be first demanding with the level of liquidity. There's a minimum, a threshold under which we will not normally take a customer, and then also the margin that I have upwards. Of course, if there is something strange, but I guess that there will be some context, and I hope that it is occasional. It happens only once. I hope I can feel sufficiently comfortable to continue going forward, and perhaps I will buy more later on. But normally we don't coexist well, and we try to, how do you say?
No sé qué, cortar por el sano, ¿no?
Sí.
To get rid of companies that are problematic directly. So those companies where we cannot build a position, and then if we cannot exit, we have a problem. Yeah, in my case, exactly the same. We have a set of criteria that establish that we cannot go into illiquid or too small companies, and sometimes a company that it doesn't necessarily have to belong to PME growth. They can go into the continuous market. If that is not liquid, we will have a control department that will tell us there's a problem here, they are running out of liquidity, and so we accompany the liquidity of that asset so that we can undo the operation whenever some of these requests happen. So this is not my first consideration, but it is the second. As I was saying before, it is a source of concern for me. Yes, but you also have to work based on common sense, of course. If you know that something is illiquid, the dose of risk that you can keep on your portfolio has to be slightly bigger or slightly smaller, to tell you the truth. So we have to do a good piece of ex-ante analysis work. If you are not very comfortable, do not give it an attempt. And if you do believe in that company, you can also go there and ask them about all the information. Well, I think that you should try not to invest in stories where the investment thesis, the investment case can change just because of one figure in a newspaper. We should prevent or avoid making decisions. You don't normally purchase everything the same day and sell it everything the same day. You have to have a warning system. We have a circumstantial situation, but we normally don't take decisions black or white. That's what we have Vegas there for. So I think there's a preliminary analysis, and we try to invest in those companies that are not talking to each other and to the others. Are there any more questions? Last opportunity. Okay, there's one question there.
Hola, ¿qué tal?
Hi, good afternoon. Javier Sanchez from Agua Sabadell. I wanted to ask about, you've been saying that the fact that there is no research, there's less follow-up, and then I don't know if it's a direct relationship between the two, but then there is no liquidity. What do? Do you trust a sponsored analysis paid for by the company, or do you guarantee that credibility, or do you think that they are more or less dependent? What is the problem? What is the solution to those many products not having a coverage? I think that the sponsored research makes sense for those companies that have just gone public, but we are not going to use that one as a basis. My point was really that with MiFID and the paper research operations, that has detached the companies a lot from the people, has changed the lives of brokers that were more local, which were the ones that really went around and look at those companies a lot more. But the big ones normally depart from that because they generate very low cash flows. So the solution, I think that it is, I'm not going to come here to propose things to you, but probably we should just give it a twist to the MiFID.
La relación que has hecho.
I believe that what you said about lack of coverage with lack of liquidity, I normally relate lack of coverage with our lack of work in that area. But of course, we are looking for pearls that nobody has seen, and that is difficult. And you have to look for that in fora or in companies visiting. But small caps are illiquid as a whole, as a general. But the lack of research is more related to the fact that managers need to look more for those companies that have a higher hidden value and that they are not so well known compared to having 50 analysts writing reports on you. Isabel from your Bolsa, where do you see the driver to get rid of this discount that we see right now in small caps? Because the management industry is becoming more and more concentrated. Do you like small caps, but you tend to raise higher the minimum liquidity requirement, and we don't believe in our market ourselves. How can people come from abroad and trust our market? What is the driver for that correction to happen and for that upside to materialize?
Bueno, yo diría que primero...
Well, I would say that first of all, we have to have good quality companies, and if you do, and they have enough size to be bought, the buyer will come sooner or later. So I don't see that there is any factor. I think it is a question of time. Time will let your real value surface. As Javier said, either some other financial investor takes it away from us, or someone from abroad, then they will take it out of the market. But some trick, a small trick to do this very easily, I don't think you will find that. Yes, I just wanted to say that the main driver is unexpected. And as unexpected, because we have a very close example last year, where the best companies were the oil companies, the raw materials, and the banks. Nobody had them because they had been forgotten, and we had ESG, oil was going to disappear, and we will not be using iron anymore, or coal or gas anymore, and things change overnight, and you find yourself with this situation. Many of them double their turnover. And so, of course, the small companies, they go through cycles. And I think that the small caps in the very long term, they may do better than the big caps, the large caps, but there are always periods when the behavior is not so good, like for example in the last 2 years. So that's why I think this is the right moment and the right time and the right place to look at that. We have seen it, we have almost no, we haven't seen such low prices in the equity markets, and of course the recession is dooming and looming, but the big companies are more diversified and more room for maneuver. But of course we have those pros and cons. But whenever there is a slowdown, economic slowdown, normally small companies do worse, and when things are fine, they do much more and they behave much better than the large caps. That's my opinion. Do you want to say something? No, that's a very complex question, really. And it has already been answered quite nicely. So I think that each consumes based on your process, you consume what you identify. And for us, it is a very clear example. And as we said before, and my colleagues have already said it, and we see a lot more value in the quality small cap compared to a large cap. That has already gone through many different hands because there is a factor or a trend that determines that. The technology is one of the areas of focus. Companies, I guess that they will provide safety and security, that they do not disappoint us, and we can go back to that niche, a specific niche in those companies, and then we will start to flow. But for the time being, really, things are very complex. Okay, so I think that we are going to close because we've taken a few minutes from the next panel. I would like to thank all those that attended this forum, Medcap 2023. Thank you to the speakers, because the discussion has been quite enriching, and thank you very much to BME, and I hope that this forum continues to be held in the next few years, and we continue coming. Thank you.
Bolsas.